Hello everyone. Good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier session, we discussed about Accounting Standard 26, that is related to intangible assets, and what is the criteria for recognition of such intangible assets if it is acquired or even if it is internally developed in the form of research and development expenditure. And after the intangible asset is recognized, how to amortize it over its useful life and how to present it in the balance sheet at a carrying amount, which is nothing but original cost less accumulated amortization less accumulated impairment losses. And also the disclosure requirements of AS 26 we discussed in the previous session. Now let us solve some of the problems related to AS 26 which were given in ICI material and some of the RTPs earlier and some of the past examination questions also. Let us discuss those problems of AS 26 one by one. Look at question number 1. K Limited launched a project for producing product X in October 2016. The company incurred 40 lakhs rupees towards research and development expenses, 40 lakhs rupees, up to 31st March 2017. And due to the prevailing market conditions, the management came to conclusion that the product cannot be manufactured and sold in the market for the next 10 years. Maybe such a level of hi-fi futuristic product they would have manufactured or invented, we don't know, but still, whatever the case may be, for the next 10 years this product cannot be manufactured and sold, means there is no market feasibility for this product, marketability is non-existent for this product, but they incurred 40 lakhs rupees towards research and development expenses. The point is, the management wants to defer the expenditure and write off to future years, and you are required to advise the company as per the applicable accounting standard. Is management correct in deferring that expenditure and writing it off in future years? Answer is no, they are not correct. Why? Because clearly this expenditure on research and development is not meeting the asset recognition criteria. Why? Because of course, anyway the research expenditure cannot be deferred, it has to be charged off to the P&L account. Even the development expenditure also can be only deferred and amortized. Deferred in the sense postponed. Amortized means they are trying to recognize it as an intangible asset and amortize it over the future years. That is also not possible even for development expenditure because of the lack of feasibility of this market, of this product to be sold in this market. So we have to refer to the conditions which are all mentioned in when can development expenditure be really amortized or recognized as intangible asset. When is it possible? Only when it meets the asset recognition criteria. Also, there should be all the conditions which are all satisfied. These things have to be demonstrated and you have to write those things. Whether there is a technical feasibility of the product, probably yes. Availability of the product for use or sale, yes. Sale difficult, use may be okay, but use they are not intending. Identification of cost incurred, they did, that's okay. But is there a probability of external market? Answer is no. When there is no probability of external market and when there is no realistic expectation that there will be sufficient future revenues, we cannot recognize development expenditure also as an intangible asset. So the management decision of deferring it and writing it off in the future years is wrong. That is incorrect. For that you have to substantiate your answer. Just you cannot write no. you have to write the provisions related to AS 26. Research expenditure has to be anyway charged to the P&L. Development expenditure also should be charged to the P&L unless and until there is a asset recognition criteria being met, and it is not met, and certain conditions have to be demonstrated by the organization, and the conditions are not demonstrated by the organization since the management already came to a conclusion that this product cannot be manufactured and sold in the market for the next 10 years. That means there is no external market for this product. That means no future economic benefits can be flowing into the organization. Even if they flow after 10 years also, we don't know how much they will be. Those are not possible to be quantified now, which means this expenditure has to be charged off to the P&L account, profit and loss account, but cannot be deferred over the period of future years. So the management's decision is incorrect. That conclusion you have to write for that question. That's a case-based question. Now, question number 2 is the most popular type of question. Like this, many times AS 26 problems were asked in the earlier examinations. More or less, it is a very commonsensical and simple calculation that will be involved in this type of questions. But yeah, number of years will vary from question to question. Look at this question number 2. Swift Limited acquired a patent at a cost of 80 lakhs rupees. That is the cost of the asset for a period of 5 years. And the product life cycle is also 5 years. So that means naturally this 80 lakhs has to be amortized over a period of 5 years. The company capitalized the cost and started amortizing the asset at the rate of 10 lakhs rupees per annum. They already started doing that. 10 lakhs rupees per annum they started amortizing already. After 2 years, it was found that the product life cycle may continue for another 5 years from then. From then, not from the beginning. That means total product life cycle is going to be 7 years, which means the net cash flows from the product during these 5 years are expected to be 36 lakhs, 46 lakhs, 44, 40 and 34 lakhs. Find out the amortization cost of the patent for each of these years. So this is a question that can be expected very well in the examination. Let us take first year 1 and year 2. Year 1, naturally they already amortized 10 lakhs, which already they did. We are not going to change that. Let it be there. So 10 lakhs, 10 lakhs means 20 lakhs already got amortized. That means the carrying amount of this patent after 2 years will be 60 lakhs. Now the point is, the remaining 60 lakhs has to be amortized over the period of next 5 years. We are continuing the numbering. Let us say 3, 4, 5, 6, 7. Next 5 years. This 60 lakhs has to be amortized. But on what basis? When there is a better basis, which is nothing but the cash flows that can be expected from this product, which is in the ratio of 36, 46, 44, 40 and 34. That should be the basis. So simply 60 lakhs has to be apportioned among the next 5 years in the ratio of expected cash flows. So what is the total of this? 36, 46, 44, 40 and 34 means 200, right? So 60 lakhs divided by 200 into each of the years. 36 means third year amortization will be 10 lakhs 80,000. You need to calculate this on calculator. Then fourth year it will be 13 lakhs 80,000. Fifth year it will be 44 lakhs, right? So 13 lakhs 20,000. Then the sixth year it will be 12 lakhs. Then the seventh year it will be 10 lakhs 20,000. That's it. That is amortization that should happen for the 5 years after the end of first 2 years, where they already amortized at the rate of 10 lakhs rupees per annum. So from there onwards, prospectively, the amortization will change. Because the carrying amount after the 2 years is still remaining in the books 60 lakhs, that should be amortized over the period of next 5 years on a suitable basis. In this case, scientific basis will be the expected net cash flows for the next 5 years. So the ratio will be 36 is to 46 is to 44 is to 40 is to 34. And if you look at the total of all this amortization, naturally that should be equal to 80 lakhs. You can check that for computational accuracy. Should be 80 lakhs, total of all this. So 80 lakhs is amortized over a period of 7 years, not 5 years now, like this. That's what was asked. Find out the amortization cost of the patent for the each of the years. This is the calculation you have to show with a table, year, amortization, and show the calculation also clearly for each of them. How did you calculate it? 60 lakhs divided by 200 into 36. 60 lakhs divided by 200 into 46. 60 lakhs divided by 200 into 44. Like that 40. Like that 34. Calculations have to be shown in order to gain 5 marks from such type of question. Similar question can be expected in the exams. Lot of times more or less same type of questions were asked from AS26. Then question number 3 once again is a case-based question. A company with a turnover of 250 crores and an annual advertising budget of 2 crores had taken up the marketing of a new product. It was estimated that the company would have a turnover of 25 crores from this new product. And the company has debited its profit and loss account the total expenditure of 2 crores that was incurred on the extensive special initial advertisement campaign for the new product. Is the procedure adopted by the company correct? A lot of times, some students will have this tendency of always telling whatever they do is wrong. Don't be in that mindset. That is not a correct thought process. First of all, whether they are correct or not has to depend upon the standard, not according to always they are wrong, always they are wrong. I will prove that they are wrong. That attitude should not be there. In this case, what the company has done is absolutely correct. Why is that? Because what is the expenditure we are looking at? That is 2 crores expenditure. What is the nature of that expenditure? That is the advertising expenditure which the company has incurred. And this advertising expenditure they have debited to the profit and loss account, which is absolutely correct because advertisement expenditure is a revenue expenditure. Okay, now, even if let us say some portion of the advertisement expenditure, if they wanted to capitalize and intangible asset they wanted to recognize, how can we identify the future economic benefits which are flowing into the organization because of this advertisement expenditure? Not possible. So there is some kind of benefit that is coming in the form of an additional turnover of 25 crores. That is turnover, not the net benefit that is coming to the organization. Yes, there might be some future economic benefit that is flowing into the organization, but we cannot match that. We cannot quantify that with the amount of expenditure that is incurred on advertising. So, asset recognition criteria under AS26 is not met. We cannot measure the cost of this intangible reliably. 2 crores is not entirely intangible. Some of that only is spent on special initial advertisement campaign. How do we know that this exactly advertisement campaign only is going to bring the additional turnover? Where is the matching of that? Not possible. Quantifying, matching, exactly taking that, directly attributing that expenditure to this advertising expenditure is not possible. So the point of whether the intangible asset to be recognized or not, in this case, answer is it should not be recognized. And that's what the company did. They have debited its P&L account with the total expenditure of 2 crores, which is part of their advertising budget of entire 2 crores, which is normal advertisement expenditure, which is revenue expenditure. They are supposed to debit P&L, they did that. So absolutely, whatever the procedure adopted by the company is correct, and no intangible can be recognized from this. That is what is a point about advertising expenditure. And always this is a big controversial, debatable issue also throughout the world, because a lot of multinationals incur advertisement expenditure extensively throughout the world, and they just charge this to the P&L account. But the argument is, by incurring that advertisement expenditure, they are creating a brand value, which is an intangible, which could not be measured reliably. So they are not recognizing it as an asset, and they are just charging it off to P&L account and claiming tax benefits also as an expenditure. Whereas ideally, they should have created an asset and amortized over a period of time, is what some people argue. But the problem is that argument has no basis from the accounting standard. Logically, it may look correct, but accounting standard never provided for such kind of capitalization of advertisement expenditure. Though there is a possibility of some future economic benefit that might flow into the organization, since that cannot be quantified exactly, it cannot be directly attributable to this incurring of the advertisement expenditure. And the expenditure or the cost of the intangible, if at all we wanted to create, we cannot measure it reliably. When all these things are not possible, we cannot identify intangible assets, so recognition criteria is not met. Hence, no intangible can be created by advertising expenses or publicity expenses. Always they have to be charged off to the P&L account. Once again, even though logically it may not be absolutely correct, according to accounting standard, there is no option. Not only in India, throughout the world, this problem is there, and that is continuing so far, unless another procedure comes out to identify the advertising intangible also as a separate standard. Till then, we have to definitely charge this advertising expenditure to P&L account. That's what the company did. There is nothing wrong that the company has done. You don't have to write about all these international things. That is only for understanding. You have to just refer to the accounting standard. And since the asset recognition criteria is not met, cost of the intangible cannot be measured reliably. Future economic benefits also cannot be exactly measured reliably and cannot be directly attributed to the advertisement expenditure so incurred. The company has to debit this expenditure to P&L account. That's what the company did, and hence the procedure adopted by the company is correct. That is the conclusion you have to write for question number 3. And another question also is similar to this. This company has spent 45 lakhs rupees for publicity and research expenses on one of its new consumer product. They want to manufacture something, let us say some soap or something they want to manufacture. For that, they did some publicity also, some research expenditure also, which was marketed in the accounting year 2011-12, but proved to be a failure, utter flop it was. State how will you deal with the following matters in the accounts of you limited for the year ended 31st March 2012. Following matters means that matter only. So what should happen to that? Simple, that has to be charged to P&L, because that proved to be a failure. There is no economic benefit that is expected in the future from this. And that too, what kind of expenditure? Publicity and research expense, both have to be charged to P&L. No intangible can be recognized from research expenditure, nor it can be recognized for publicity or advertising expenditure. Hence, the treatment here is simply charge it to the P&L, no intangible to be recognized. That's it. Now, another question, question number 5. ABC Limited developed a know-how by incurring an expenditure of 20 lakhs rupees, and the know-how was used by the company from 1/4/2005. Useful life of the asset is 10 years from the year of commencement of its use. That is the total life. Company has not amortized the asset till 31st March 2012. Past journal entry to give the effect to the value of know-how as per accounting standard 26 for the year ended 31st March 2012. So simple point here is they are supposed to amortize according to AS 26 when there is an intangible asset, in this case which is know-how, with a cost of 20 lakhs. They should have amortized it over the period of 10 years, but they did not do that. That's a mistake. When there is a mistake, an error or omission that happened in the previous year's prior periods, such an item can be called as a prior period item, but that will be recognized as an expenditure now, showing it as a prior period item. For that purpose, calculate how many number of years they did not amortize. That means how many number of years of amortization they forgot or missed to pass in the books of accounts. So for 2005-6 they started. From there you can start this computation, because they acquired or used by the company this asset from 1/4/2005. So 2005-6, 6/7, 7/8, 8/9, 9/10, 10/11, 11/12. So 7 years they did not do. But We are looking at the accounting for the year 31st March 2012 ending. So that means 6 years they did a mistake. So what we can call this is now as amortization. That is prior period item, not current year amortization. That is for 6 years. So 6 years amortization will be how much? When you say 20 lakhs is the cost of the asset and 10 years is the life. If you take straight line basis, because there is no other option, 12 lakhs will be considered as a prior period item that will be debited now. But that is a prior period item, it should be disclosed separately. And then P&L account normally has to be debited with the current year's amortization, that is 2 lakhs to this know-how account or intangible asset account 14 lakhs. That is the entry we can pass. So the book value or the carrying value of this intangible asset in the books going forward after 31st March 2012 will be only 6 lakhs. Naturally, because 7 years already passed by, 3 more years are there to be yet to be amortized. So 6 years amortization they did not do, so we debit it as a prior period item. Current year's amortization we debit to P&L, and intangible asset will be credited. That's all. That is the entry which can be passed. For that, you have to give explanation once again why 12 lakhs is a prior period item, since it is resulting from an error or omission result related to the periods prior to the current financial year. That was question number 5. Once again, question number 6 also is similar to question number 2. As I was telling, similar questions were asked many times, only just numbers change. A company acquired a patent for 1200 lakhs. The product life cycle has been estimated to be 5 years and amortization was decided to be in the ratio of estimated future cash flows, which are as under 1, 2, 3, 4, 5. But ratio is given there, that is 600, 600, 600, 300, 300. That is the ratio. Or you can say, if at all, for computational purposes, 2 is to 2 is to 2 is to 1 is to 1. That should be the ratio in which this 1200 lakhs is supposed to be amortized over a period of 5 years. Now, situation has changed. After the third year, after the third year, it was ascertained that patent would have an estimated balance future life of 3 years. That means what? Total life of 6 years now. So there is 1 more year added to the life, which was originally not contemplated. Originally there were only 5 years. Now maybe it will be there useful for 1 more year, because from there at the end of third year onwards, it is going to have an estimated balance future life of 3 years. So end of third year onwards, balance 3 years means 4th, 5th and 6th years. And estimated cash flow after the 5th year is expected to be 150 lakhs. That is the cash flow expected to be for the 6th year. 150 lakhs, right? That is given. You are required to determine the amortization pattern under accounting standard 26. Quite standard type of question. Similar type of questions can be very well expected here. So let us calculate this using the first 3 years, the same kind of ratio, because first 3 years we are not going to have a dream that life of the asset is going to be increased. So they have to be just amortized in the same ratio. So if at all 1200 lakhs has to be amortized in the ratio of 2 is to 2 is to 2 is to 1 is to 1. What will be that? 1200 divided by 8 into 2. That means 300, 300, 300 would have been already amortized in first 3 years. 300, 300, 300. You have to show the calculations. That is nothing but, you can show 1200 divided by total of this. How much will be that? 2400 into 600. So 1200 by 2400 into 600 is nothing but 300. Like that, first 3 years 300, 300, 300 amortization would have happened already. So now the point is, how much would be the balance of this asset at the end of third year? Already out of 1200, 900 has been amortized. That means the remaining is only how much? Remaining is only 300. This 300 has to be amortized in 4th, 5th and 6th years. In what ratio? That should happen in the ratio. Now 300, 300, 150. In other words, now we can say 2 is to 2 is to 1. But how much amount has to be amortized? 300 has to be amortized. So you can say like this also, 300 divided by 750 into 300. That is 120 in the fourth year. Again 120 in the fourth year, naturally 60 in the sixth year. So 120 plus 120 plus 60. That will be how much? Naturally 300. So this 300 is going to be the future amortization for fourth, fifth, sixth years. 1, 2, 3 years already what happened is 900. And naturally, the total of these two is 1200 lakhs, which is supposed to be amortized throughout the life of the asset. So 900 plus 300 is the point. So like this, calculations have to be shown how the amortization has to happen of the intangible asset according to the cash flows ratio. Expected future cash flows are only useful for ratio determination. Originally the ratio was 2:1:1. Accordingly, first 3 years 300 lakhs would have been amortized. Then remaining 300 will be amortized in the ratio of 2:1 in the fourth, fifth and sixth years. That's all. Total amortization has to be 1200 lakhs, which should be the original cost of the intangible asset. That kind of question can be very well expected. Question number 6 was that. Now, question number 7 is related to cost of an intangible asset in the form of a low-risk computer software product. Enterprise incurred the costs to develop and produce a routine low-risk computer software product. So, there's a software company maybe. They will research on that and they will develop it and then sell it. So, the point is what amount should be capitalized as a software cost in the books of the company on the balance sheet date. Balance sheet date means we are talking about again intangible asset. So research phase should not be capitalized. Capitalized how much is the question. Only development phase has to be capitalized. Production also should not be capitalized. So what are the ones which have to be capitalized? One by one we can check. We have a detailed program and design. Can program and design be called as development? No. That is research phase. So definitely this cannot be capitalized. Research phase has to be charged to P&L. Coding and testing can be called as a development phase. Other coding costs can be called as a development phase. Testing costs can be called as a development phase. That is also part of it. And product masters training materials also can be called as development phase. These are all the things that happened before the production actually happened. Pre-production costs we can call. Pre-production costs, but after the research is done. So only things which can be called as development costs in this are these four. They can be capitalized. Then what about duplication of computer software and training materials from product masters? They are producing it actually. 2000 CDs, let us say they are making. That is a production cost, not a development cost. Packing cost is not a development cost. Those two are production costs. So 25,000 is a research cost. 40,000, 11,000 are production costs. They cannot be capitalized. So naturally, how much can be capitalized? Only 20,000 plus 42,000 plus 12,000 plus 13,000, total 87,000 rupees is the final answer that can be capitalized. For that, you can make a statement, copying, pasting the same things, just writing that particular amount and computation of amount to be capitalized according to AS 26. But you have to give reasons. 25,000, why should not be capitalized since it is a research expenditure. 40,000, 11,000 should not be capitalized because they relate to the actual production of the product. Actual production costs are not to be capitalized. They are normal expenses, cost of production that is. So 87,000 only should be capitalized by this software company according to question number 7. Now, question number 8, type of situations can be given 4, 5 according to the number of marks awarded, and each of them can be awarded 1 mark or 2 marks as the case may be, and very much possible to be asked about in the examination. Such type of questions are quite possible. So look at question number 8. As per provisions of AS 26, how would you deal the following situations? One by one, let us see. Point number 1. 23 lakhs paid by a manufacturing company to the legal advisor for defending the patent of a product is treated as capital expenditure. For defending something, already we have a patent and somebody would have probably filed a suit against us and our legal advisor has charged 23 lakhs. Is that a capital expenditure? Answer is no, that is wrong, because it is not going to add any value. It is a further expenditure. When a further expenditure is incurred on the asset, that should bring some additional benefit to us. It should not be just something which is maintaining the existing capacity or capability of the asset. If that is the case, then it cannot be called as a capital expenditure. It is a revenue expenditure. So this treatment by the company is wrong. Then point number 2. During the year 1819, a company spent 7 lakhs rupees for publicity and research expenses in one of its new customer product, which was marketed in the same accounting year but proved to be a failure. I think we already discussed this. What should happen to that? Simply just debit it to P&L. No recognition here. There should not be any recognition of intangible asset because that product is already a failure. It does not meet the asset recognition criteria. That too, publicity and research expenditure never will be intangible assets. So second point, it should be charged to P&L only. Third point, a company spent 25 lakhs rupees in the past 3 years to develop a product. These expenses were charged to the P&L account since they did not meet AS 26 criteria for capitalization. In the current year, approval of the concerned authority has been received and the company wishes to capitalize 25 lakhs by disclosing it as a prior period item. No, that is not correct. Prior period item is only possible when there was an error or omission in the earlier years. Earlier, there was no error or omission. It did not meet the criteria for capitalization. Once it did not meet, it did not meet. Suddenly now, some approval of concerned authority comes, they cannot capitalize it. So that is also wrong. They cannot capitalize just because of some internal decision. Okay, we'll capitalize it. No, not like that. So if it is already charged to P&L earlier, done deal, over. Now it cannot be reversed because it is not something which has resulted because of an error or omission earlier. They did not do anything wrong earlier. They did perfectly right earlier. Because then this expenditure did not meet the asset recognition criteria. So they charged it to P&L, which was absolutely right. Now how can they say that it is a prior period item? It is not. Why? Because there is no error, no omission earlier. So whatever they did already, that will just stay good. Now you cannot reverse that. Now they cannot capitalize 25 lakhs freshly because their management or somebody has approved it. That is a wrong treatment in that case also. The explanations for those questions have to be given. So these are the types of questions that can be expected in the examinations. And a very similar question once again, an enterprise acquired a patent for 400 lakhs, the product life cycle was 5 years, amortization was decided to be in the ratio of estimated future cash flows. This is the ratio 2:1:1. After third year, it was ascertained that the patent would have an estimated balance future life of 3 years. And after the 5th year, the cash flows are expected to be 50 lakhs. Determine the amortization under AS 26. Same type of question, only just amounts changed. So originally, let us say first year, how much should be amortized? Total 400 lakhs divided by, what is the total of this? 800, right? So 6 plus 800 into 200. That means in the first year, 100 lakhs would have been amortized. In the second year also 100 lakhs would have been amortized. Third year also 100 lakhs would have been amortized because 3 years they did it already. Remaining is 100. That should be now amortized in the ratio of 2:2:1. That means 40, 40. One more year is added now. That is 6th year. In that year, it will be 20. That's all. This is the pattern of amortization. 100, 100, 100, 300, 40, 40, 20 will be there for the next years. That means 4th, 5th and 6th years. So simply you have to just write the years 1, 2, 3, 4, 5, 6 like that. And you show the calculations. How did you get this? First year, second year, third year, 100 lakhs. Fourth year, 40 lakhs. Fifth year, 40 lakhs. Sixth year, 20 lakhs. That's all. Same calculation has to be just shown. Then 5 marks can be expected from such kind of questions. Very similar questions were asked many a time. Now let's move on to little different question. Question number 10. Plymouth Limited is engaged in research on a new process design for its product. That's good. It had incurred 10 lakhs rupees on research during the first 5 months of the financial year 12-13. Development of the process began on 1st September 2012 up to 31st March 2013. So anyway, this research expenditure 10 lakhs has to be charged to P&L. There is no second thought on that. Development expenditure, yes, we have to check. A sum of 8 lakhs rupees has been incurred as development phase expenditure which meets the asset recognition criteria clearly given. And from 1st April 2013, the company has implemented a new process design and it is likely that it will result in an after-tax saving of 2 lakhs rupees per annum for the next 5 years. Cost of capital is 10% and present value of annuity factor of 1 rupee for 5 years at the rate of 10% is already given. Decide the treatment of research and development cost project as per AS 26. Of course, first point you have to write, research cost 10 lakhs has to be charged to P&L. It cannot be capitalized. It cannot be recognized as a intangible asset. Not possible. Then the second point comes about 8 lakhs. Cost is okay, 8 lakhs, that is fine. It is recognizable. So are we going to just recognize it at 8 lakhs always? No. When you know that exactly the future economic benefits are going to flow, how much they are, when there is an estimation already, then you have to find out the present value of those future economic benefits, and whichever is lower has to be recognized as the cost. So here, how much future economic benefits might be coming into the organization? After tax saving of 2 lakhs rupees per annum can be there, he says. So when 2 lakhs rupees per annum can be there, multiply with the annuity factor, because anyway that is going to be the same amount each year, 3.7908. 3.7908. So what is the present value of the future economic benefit? So 3.7908 into 2 lakhs means how much? That will be 7 lakhs 58,160 rupees only. But cost was 8 lakhs. The question is, should we recognize the asset at a cost of 8 lakhs or 758,160? Whichever is lower has to be recognized conservatively. 8 lakhs should not be recognized, which means, that also means we have to also show about the remaining. What about the remaining 41,840 rupees? Where it will go? Naturally, it will go to P&L. So the research expenditure of 10 lakhs anyway will be going to P&L. That 10 lakhs plus this 41,840, that will go to P&L. Whereas 758,160 will be going to the balance sheet as an intangible asset recognized. 7,58,160 is the recognized intangible asset as per AS 26. That was question number 10. Then question number 11, once again, is a cost of intangible asset type question. The company acquired for its internal use a software on 28th of January 2012 from USA for US dollars 1 lakh. Exchange rate on that date was 52 rupees per dollar. Seller allowed trade discount of 5% and other expenditure is given as this. Compute the cost of the software to be capitalized. Once again, there should be a statement and then you have to just find out each of the items. First of all, $1 lakh original purchase cost minus 5% trade discount means that is only $95,000. $95,000 multiply with 52 rupees means 49,40,000 rupees is the original purchase cost in rupees. 49,40,000. Then add import duty. Import duty how much? 20% of that means 9,88,000 should be added. Yes, it should be. Then purchase tax 10% it says. Maybe that is on both 49,40,000 plus import duty. Like that we can say, though it is not clearly given. So let us assume like that. So on the total of purchase cost plus import duty, if it is purchase tax, that is 10%. If that is the case, then 5,92,800 will be the purchase tax. That should be added also. If you take only on 49,40,000, 4,94,000 also not a problem. That's also okay. Then entry tax 5%, recoverable later from tax department. So should we take it? No, we should not take it. That is recoverable, so there is no point of adding it. Installation expenses 25,000, should they be taken? Yes, they should be. Professional fees for clearance from customs. Yes, it should be also taken because these are all the costs incurred before the intangible asset, the software was ready for its intended use. So you add all of them. Total will be how much? That is the cost at which this intangible asset has to be capitalized. 65 lakhs, 65,800. Check that once again. 4940, 988, 592, 800, 25, 20. 65 lakhs, 65,800. That is the answer for this question. That is the cost of the software to be capitalized. Just like any other asset, even AS10 also, instead of software, if you write any other machinery also, same type of calculations will be there, nothing different. But instead of machinery, if it is software, AS26 we call it. That's all. 65,800 is the final answer. Now moving on to the last question, question number 12. Versus Mahesh Limited is developing a new production process during the financial year ended 31st March 2013. The total expenditure incurred on the process was 60 lakhs. The production process met the criteria for recognition as an intangible asset on 1st December 2012. Means any expenditure incurred prior to that will not be possible to be capitalized. Once it meets the asset recognition criteria, then only it can be capitalized. No? Prior to that, whatever expenditure is incurred, that cannot be capitalized. That can be considered to be a research expenditure. And it was given. Expenditure incurred till date was 32 lakhs. That means 32 lakhs has to be charged to P&L as a research expenditure since it did not meet the asset recognition criteria, because first time when the asset recognition criteria was met was on 1st December 2012 and this 32 lakhs was incurred before that date. So 32 lakhs to be charged to P&L is that treatment. Further expenditure incurred on the process for the financial year ending 31st March 2014, that is next year, was 90 lakhs. Okay. Further, some more development expenditure has been incurred. And as on 31st March 2014, the recoverable amount, not account, amount of know-how embodied in the process is estimated to be 82 lakhs. Recoverable amount is 82 lakhs. This includes the estimate of future cash flows and inflows. So 82 lakhs is the recoverable amount. How much is the cost that we have to calculate? What is required here? First question, what is the expenditure to be charged to the P&L account for the year ended 31st March 2013? Answer was clear. Already we know that. That was 32 lakhs. Why? Because that was not meeting the asset recognition criteria. Then, on 31st March 2013, what was the carrying amount of the intangible asset? Okay, forget about 4 months amortization and all that. Just what is the cost of the intangible asset, that is their carrying amount on 31st March 2013. Total amount was 60 lakhs and out of that 32 lakhs already charged to the P&L, which means naturally remaining is capitalized. The answer will be here 28 lakhs. Third, what is the expenditure to be charged to the P&L account for the year ended 31st March 2014? That is an interesting question because already there was 28 lakhs. Plus, during the year 2013-14, another 90 lakhs was incurred, right? That means the carrying amount is ideally supposed to be 118 lakhs, but recoverable amount is only 82 lakhs. That means what? There is an impairment of 36 lakhs. What should happen to this impairment? That should be charged to P&L. That should be charged to P&L. That means how much? 36 lakhs has to be charged to P&L for the year ended 31st March 2014. 36 lakhs is the answer for third question. And what should be the carrying amount at the end of 31st March 2014? Naturally 82 lakhs. That is the remaining amount. So 82 lakhs is the carrying amount on 31st March 2014. These are the 4 questions. 4 marks question like this can be very well asked. Important type of question which was asked in the earlier exams also. Such type of questions can be asked in the examination from Accounting Standard 26, and as we discussed already, is 26 is also one of the standards where numerical questions can be expected. Mostly the amortization type of questions were asked earlier, but not necessarily. Sometimes case-based questions, whether asset recognition criteria is met or not, that type of questions, or whether development expenditure can demonstrate the conditions wherein it can be capitalized. Such kind of questions can be asked. And also questions like this where the impairment possibility is also there, and questions like the earlier one where present value of the future economic benefits is less than the cost, then what should we do? We should recognize only the whichever is lower. So any type of question like this can be expected in the examination. Being thorough with the standard makes us clear about how to answer those questions when we encounter them in the examination. With that, we can conclude AS 26 problems also, and in the another session we'll discuss about another accounting standard. Till then, take care. Bye bye. Thank you very much.